So this week we are reviewing chapters 6 through 10, and the book we are going over is Tax-Free Wealth, which is part of the Rich Dad, Poor Dad books. And Natalie is leading our conversation. So Natalie, go ahead.
All right. So this last reading, we went through chapters 7 through 10. And again, I think we're getting more into the nitty-gritty of the book. I think the initial couple chapters were a good review of what to expect and a good high level of, assessment of where you're at. And now these chapters are kind of honing into the detail level of here's where you can make changes in your life. And I think you guys probably, I don't know if you guys feel the same, but some of them, I feel I definitely don't use today. Some I think I could use, and others I don't know when I'll have the opportunity to use. But the first chapter was chapter 7, the depreciation, king of all deductions. And in that chapter, he gave the example of his friend Ches Pierre, of the restaurant owner who he bought $1 million property. They had the $220,000 in land, $780,000 in depreciation that they split by 680 in actual estate, and then 100K in the supplies. And then they walk through the example of how to depreciate that out. Reading through that chapter, I know I felt kind of excited, like, wow, that's a lot of opportunity for tax write-offs and see some impacts to your actual income taxes. So did you guys have any thoughts on walking through that example? Because he does reference it quite a bit for the rest of the book too.
Yeah, I'm mad. My CPA doesn't do that.
It means mine doesn't either.
Mm-hmm.
So
yeah,
I found it very so all of the stuff he's like going through, he's like just simplifying it. So like for instance, cost segregation, I never really did it because it was like confusing. I wasn't quite sure exactly what you used it for, and then how you like put it together. And then he explained it in here, and he was like, before he even mentioned cost segregation, like Lexi heard me just out of nowhere. That's how you do a cost segregation. And then like 5 seconds later, he's like, yeah, so you just, you end up getting a CPA and you get an engineer and they do a segregation study for you. And so like, I don't know, some of the stuff in school makes more sense now. Like they always told you like land's not depreciable. And I'm like, well, why does that even really matter that much? It's like, well, if you're doing an investment property, you got to take the land part out before you do anything. So, and then everything else you can actually depreciate faster. Like, you start buying equipment, you start buying capital improvements if you're flipping a house, all that kind of stuff. So yeah, I mean, it's awesome. You're just explaining paper losses. So.
Well, that's interesting perspective because you're kind of our CPA expert in our team, and so it is a relief that you're kind of making sense of it too. It kind of brought me back to my college accounting classes too, of going through this and seeing these terms. And it's like, oh yeah, I remember learning those differences.
Yeah, well, for me, it was just another eye opener and another, I guess, aha moment. He talked a little bit about having multiple companies and having, like, I think he even had like a payroll company, and just realization of how close, yet how far we are in our own, we're heading in the right direction with what we're doing physically, but I don't think we're heading in the right direction with the taxes. I keep saying that I think my CPA, we've just outgrown her. I think she's great if you're a W-2 and you want simple taxes, but when it comes to those tax strategies, I think these chapters just really reinforce the need for the appropriate team. And so I think for me, it's just a matter of, a friend of mine has been saying I should use his CPA tax team, and, Craig's working on some stuff as well. So we're kind of trying to see where those chips fall. But it was a lot of different food for thought in all of these chapters because, again, I hope to add properties to the portfolio year over year. And then I think it also kind of explained or gave me a few ahas as to why the big investors only hold their properties for a certain period of time. I always wondered, like, why would you sell it if it's cash flowing? But then I realized in this chapter that the cash flowing part of it, while that is great, I think that brings in the smallest part of the income from rental properties. I think the depreciation and the write-offs and all of those things give you more income in essence, or more money in your pocket. And so it just made sense as to why, like Jar House, they buy, they hold for 7 years, they put a tenant in it, and after 7 years to the day, they are selling that property. And I think sometimes they even potentially take a loss on the sale, which is another tax break for them when they are doing their taxes. And so for me, it was a different way of looking at my rental properties. And I don't really want to I want to come up with a strategy, whether it's 7 years, 10 years, but I want to come up with a strategy on how long we hold and what the objective is, not only in profit, but in, different other strategies or benefits for keeping the property.
When I wonder if it's because kind of how he split it. It was $780,000 in the value of the building, but then the 100K supply. So as soon as that 100K depreciation is gone, that's when they get rid of the property.
Correct. That's what I'm thinking. Is that's when they are out.
Interesting. Craig, any thoughts too? Any ahas?
No, I mean, you guys are kind of hitting the point. I'm just kind of, in agreement of this is some very interesting stuff. I mean, I know that I like his phrases, kind of not free money. What was the magic money?
Magic appreciation's like magic, yeah.
Yeah, and so there's definitely a lot to ask me. Now, I hit it a lot of times with though I kind of kicked the can now, and I'm glad I'm learning about this because now I understand some of the meaning behind it. But I do a lot of asset purchase agreements for businesses that are buying and selling businesses. And part of the requirements, and I would kick that can, is what are you buying? Okay, I'm buying the business for $1 million. No, you're not. You're buying $300,000 for a building, $100,000 for equipment, $200,000 for this, 200, goodwill, all this stuff. And to break it down, because I knew it meant for something that you want to see that. And sometimes it's more advantageous to a buyer, sometimes it's more advantageous to a seller. But again, I don't do tax advice. Usually you talk to your CPAs and just kind of figure this out and work it out. But now I'm understanding what the whole purpose of it is that, okay, well, goodwill depreciates at X value. Real estate or commercial building depreciates this, equipment depreciates at different values. So that's why it's so important to figure out, okay, how much are we allocating? And if you can depreciate something, maybe goodwill over a 5-year period, well, then let's make as much goodwill as possible because the building is 37 years or whatever that is. So it's definitely, I think we're all kind of hitting on that, like, ding, 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 ding. Oh, now I understand why we always talking about some of this stuff. So kind of it's filling in some blanks. I'm fascinated by it, to be honest. But now I'm also, I know Laura mentioned a couple of times, we're trying to figure this out because he's just getting into, and I might be a chapter behind, maybe, I don't know, but talking about trusts and utilizing those. Mm-hmm. And that's kind of what I'm trying to build in my practice, add some pieces onto that, some kind of tax trusts that are geared towards minimization of tax liability. And then I already mentioned even an accountant that I work with, or he's not a CPA, but he has an accounting firm that he's got a CPA on staff. But he's building his whole accounting practice around deferred tax issues and reduced tax mitigation by utilizing of trust only. So that leads to that. I'm not sure if he's doing the bigger, broader scope about businesses and stuff like that. And then it's just kind of a matter of tying in potentially the trust on the back end. And and that's kind of what I was talking to Laura about over the past probably a week or two, is that we're on a creative foundation soon after. And even for some of the income that we have, we take $30,000 a year and throw it as a charitable donation to our own foundation, which then we're going to use to buy our farm. But so utilizing those type of foundations and trusts to try and pull some money out of our own income to take over, how do we reduce our income? Well, we'd make a charitable donation. But what kind of charity? The Laura Lerman Save Our Alpaca Foundation.
Save an alpaca.
Farm.
But yeah, so
it's going to be Love a Llama.
Love a llama.
Love it. So I mean, it's just like hitting on so many different things that Laura and I are building into our own lives at this particular point in my practice area and then her practice area, and so it is kind of pinging a nice. Now, a lot of it is well over my head, But all I know is the fact that our accountant is not doing a good job. It reinforces, the more and more I hear about it, I don't know, to be honest, Laura, I mean, I never asked her the question. I don't think it is. I don't think she's doing all the depreciation that she should be doing. I don't think she's as qualified as what we want for what we want. But I don't know. I'm interested in the book.
Yeah, I think one thing I keep on coming back to is like it's the conflict of, should I be the expert on how to pay taxes, or should we find a CPA that is the expert to make sure that they're doing due diligence? And it's almost like, gosh, how do I hire this Tom Wheelwright's company?
Well, Rich Dad, when in Rich Dad Poor Dad, when we read that book, he talks about outgrowing your professionals, right? And that a true professional doesn't take offense to the fact that you as a consumer have outgrown them. If your professional gets angry at you for hiring either new members or completely replacing them as on the team, then at the end of the day, the problem lies within them and not within you. You can't allow your success to be dependent on someone else's happiness. And I think that for us, our CPA is actually a good friend. She has crossed the line. And so, those kind of relationships make it difficult. And I think that, as I formulate my business and Natalie, you formulate your business, it's very important as you work with friends and family to realize that they may not use you next time because maybe you didn't do things correctly or right or whatever. But I think at the end of the day, it's up to the consumer. It's up to you as far as who's there, because she's not going to write me a $200,000 check every year just for using her.
Nope. I think you write her a check for using her.
Right. And sometimes it's a big one.
And the same thing with our financial advisor. We kind of, hey, we kind of want more from you. And he's like, well, fire me. Okay, fine. Like, really? Like you got all pissed off that we're questioning his not professionalism, but his understanding of what we want on a financial level and what we want to do. He's like, well, you don't think I'm doing a good job, and with my limited 3 things, then go. Okay, well, thanks. Great conversation.
Yes.
He's very pissed off about it, but whatever.
We call that a bully, and they are.
I feel like professionals a lot of the times use that as a way to kind of like, get people to stop asking questions. Because I mean, Craig's laughing, but like, because if you think about it, sometimes I feel like when you get upset, it's because you don't fully understand it, right? Like if somebody comes back and starts asking questions, if you can't explain it in a second or third way, then what do? Just repeat what you just said? And then at that point, you just start getting frustrated. Oh, this client doesn't, you know what, if you don't understand, maybe you just don't like what I'm doing, maybe whatever, and it's like, I think the problem is do you understand? Like for CPAs, honestly, when it comes to hiring, I feel like there's 3 different things you're looking at. Their understanding of like accounting laws, so GAAP, general accounting, the accepted accounting principles, then the tax law, and then on top of that, like you'll see CPA firms generally do tax audit and advisory. Well, the advisory is on the system side. Accountants are trained on controls, because an out of control system makes our job 10 million times harder, and it's like, I feel like this book's doing a really good job of really kind of explaining like what all an accountant can or should be doing, that then translates into, okay, well, how do I find a profession? You already have like somewhat of an understanding of what an accountant should be.
Mm-hmm. Yeah, I think it's really bringing that to light. Well, moving on to chapter 8. That chapter was on earning a better income. And so they definitely brought up the quadrant again of EBSI and where, I feel like the tax-free wealth is really based on you either need to be a business owner or an investor. If you're not one of those, you need to start being them to take advantage of these credit or all these tax benefits that he's talking about in the book. And so I thought this chapter was interesting because of that, of how do you get into those other businesses if you're not, if you are just a W-2 income person right now, and where you should begin, and how to keep on growing there. He had some great, I know probably most of you guys don't have the book, but he had some great different charts of how to assess each types of income. And has anyone gone onto the website, the tax-free wealth sheets or anything?
Yeah, I have it up right now.
Okay. If he offers
Um,
any of these.
I can't share it though because it's on another computer.
Oh.
But yeah, I mean, a lot of the stuff he talks in here is like really interesting. He goes through like you know, the tax brackets and all that kind of stuff.
Yep, and that goes into chapter 9, which was, I think, Craig, you hit on that too, about the trusts and how to take advantage of your tax brackets, give business to your parents or to your kids.
That's
I
one
know
of my biggest concerns is, I mean, I love the tax deferralness of it, or the mitigation and the lower, but right now that I've given my parents all this money, and sure, we didn't pay less taxes, but I want that money. So how do I get it back? I don't know if I'm in the next chapters that are coming, or if I stopped too soon and I haven't gotten far enough per your assignment, Natalie. I apologize if that is the case.
you're okay.
But even with the kids, like, yeah, I'll pay my kids 12 grand a year, but that's my money. Like, so like, how do I spend that money now that I've given it to them? Sure, now I've saved a whole bunch of taxes, but I still want to spend it. I don't want to leave that in their control. And now I guess potentially then that's some of the family trust and the personal trust stuff. Okay, instead of giving I put the personal trust as the ownership. So it goes into the personal trust, and then I'm managing the personal trust, and then I have the personal trust that pays me a salary back on that particular point. And so there's a way, and then the personal trust that for my kids actually buys my car. And so there's a lot of different things that I can do with the trust side that I've been learning about, but I still, he's doing a lot of different things about how to mitigate with using your family members. And sure, control is one thing, but it's also use that I want. And am I missing something, or is that we just haven't gotten there yet, or is that something else?
I remember
So
him saying, or I'm sorry, didn't he say like, he always gets asked that question, what do you do with the money? Do you actually give the money to the kids? And I don't remember what his answer was to that. Does anyone else?
I had a very similar question. I was like, okay, going through all of this, like, and then obviously wills and estate planning helps, but like if you have siblings and your parents are a third owner in your business, like how do you mitigate all of those? I had a lot of the same questions, so I don't know that that's a strategy I would personally want to use, but I think it's a cool strategy to know of, because had we known about, the ability to pay your kids or have your kids part owner when they were younger, I mean, my kids would have been getting a salary from the time they were 5 until now. I mean, there's always things you can do to teach your kids and have your kids do something that's, they always say you got to be careful. My CPA said, don't pay your kids exactly 13,000 a year, because you got to be able to make sure you can justify if you make that payment to them. And I'm like thinking, they're 15, 13,000 a year. I mean, that's $1,000 a month. That's not a big over the top salary, but I just think of all the money, each kid probably spent $5,000 a year, so if you do the math, that's $5,000 a year. Well, yeah, probably about that much with extracurriculars by the time you do travel and all the things, times 5 kids times 18 years. I mean, that's almost $250,000. I mean, $500,000 that Craig and I have let go out of our house that we had to pay taxes on. And we're in a high tax bracket. So when you look at the amount of money that my CPA left on the table, I guess one of my things is, oh my God, can we afford a better, more qualified group of people? But when you start running the numbers like that, it's like, well, yeah, because I'm sure it wouldn't have cost me what I paid in taxes just for the kids' extracurriculars. But I had the same question. Like, I'm not interested in giving up my business for a tax break to family members. I'd rather find other loopholes.
I know it's like as soon as they turn 18, can you take it back?
Well, Well, sure, man. And then again, so like all like for us, I mean, obviously we have access to all our kids. It's all Bank of America, and Laura and I can open up our app, and we can move money to wherever we want to move between us and
Yeah.
all kids. So every time they get a payroll, do we just take the money back and transfer it back into our account? And,
Is it just on paper?
well, no, that's a real transfer. I mean, it's a bank transfer, and then the money's going into our account. But payroll wise, on the corporate tax returns, because I mean, we're not really getting. I mean, I guess an audit would show, well, what happened to, but now again, then the kids can give us money back, right? So now we've given them 12 grand. No, they've gifted us back 12 grand. So now there's no tax liability on that. So, okay, we paid them and then they gifted it back to us. That works to me.
Yeah.
As
Well,
long
and
as
you're
you're not over 12, wherever the 13,000 annual gift deduction is per year. I think if that's what we pay them, then they're not paying, so they're having minimal taxes, they're not getting paid enough, and then they're gifting it back to us, and they're not paying taxes on the giftor, and we as a giftee never pays taxes. So, I mean, I guess that would work, Laura, by the way.
So it's very interesting because I was thinking a completely different approach. So like what he's explaining here is called income splitting. And so it's essentially a way to move your income to, in his point, lower tax bracket individuals to where they may not even really have to file the taxes. And then from there, as you essentially, so like what he was saying, kind of rolling it up into a trust. For instance, I know during COVID, there was quite a few individuals that had parents that needed support. Well, if you think about HIMSS from a trust standpoint, health, education, support, and medical, well, then that's money you don't have to pay for, right? Because now they have a trust that can essentially pay for that themselves.
Maintenance, by
And
the way.
so, huh?
Maintenance, not medical. Health, education, maintenance, and support.
Thank you. Thank you. And so, and then on top of that, it's like every dollar that you go and put in that trust, you take that, multiply it by your tax bracket, and that's your tax saving for that year. So not only are you spending less on your kids and then parents that need to be taken care of, you're getting the tax benefit and essentially access to capital. You've essentially got balances rolling up in other places, and you're a trustee. Then at that point, you can kind of figure out how to utilize that in some other way. That's kind of how I thought through it. But for this chapter, it was very interesting because income splitting has always just been something I haven't fully understood. I get the concept of it, but now that he's gone through it, I'm like, wow, okay, actually a really simplistic way of just thinking about it. Natalie, you're muted. Our fearless leader.
Sorry about that. I was saying that maybe I need to read through that chapter again. Well, he did talk about the one example where the owner's daughter was married to another person, and the other person had a regular W-2 income, and she had this trust income. And so I didn't catch if she was actually getting paid money or if she was just filing taxes to save her parents money on their business. So I didn't think that they were actually paying her, but to walk through that one more time. Okay.
Yeah, I don't know if they're just line notations that they're making on their tax returns, but I think if they got audited, they have to show that the money actually left per the statement, I think. But yeah.
Oh yeah, you just keep your documentation.
Well, we got the documentation that actually did move though. I mean, not just a paper notation on the, hey, yes, I paid them, but actually didn't actually pay them anything.
Mm-hmm.
Interesting. Okay. Then the final chapter 10 was on credits, the cream of the tax savings crop. And this one was interesting. It goes back to your new charity that you're developing and all those opportunities, education to just write things off. And like, there's so many of those out there, and it's hard to know which ones you can actually take advantage of. And are you asking your CPA the right questions, or are they asking you the right questions? Did you buy new Teslas last year, or the electronic vehicles? And there were so many tax breaks for those in the last couple of years, and now I think those are all gone. But and then buying new houses, there was a time when I bought a house where you got if you bought it in the right time, you got $8,000 of free money, never had to pay it back. But if you bought it after that, you had to pay that money back. And so there's been so many of these credits out there over the years that I've seen, but I can only imagine what else is available out there.
If you renovate your house, do something energy efficient.
Oh yeah.
Yes. Well, I think knowing what the credits are, and again, that goes back to having a strategy at the beginning of the year and revisiting it every single quarter, right? You're looking to buy a house. What are you looking to do this quarter? Okay, great. Here are your opportunities to save that money. I mean, at the end of the year, we do a donation to our deferred accounts, but that's kind of our only advice. And there's just so much more out there, like so much more out there. I mean, I always say that I'd rather give the money to a charitable organization than the fucking government. The government doesn't know how to spend it.
The llamas do.
The llama.
Llamas.
So it's funny because I'm gonna have to advocate for accountants here a little bit because so I have clients where it's like, at the end of the year, they're now asking this question. And so it's just like throughout the year, it's funny because I'm always asking questions and people are always turning their head like, why are you asking? I'm like, ugh. And so it's like, I had a conversation with a client recently just to find out that they were like headed to a completely different state. I'm like, yo, when were you going to tell me about this? And so it's like, one, keeping up with the clients to even find out what they're doing. Because sometimes they'll just tell you, oh, I'm out of town on whatever, or, oh, I'm doing this. And so now I have to ask, like, is it you just out for fun, or are you talking to somebody? And then if they tell me something like, oh, well, it's not for business, I'm going to go do this. And I'm like, well, can you do this? And so it's like, if I don't actually have that opportunity to sit down, because some clients, it's like you can't even get them on the phone. Then at the end of the year, it's like, hey, I need this, this, and that. And I'm like, hey, did you see all them phone calls I sent you? So it's like, sometimes it's like, I think people don't understand that there are certain things that can be done. So it's nice to kind of have like that CPA that understands like, kind of not only the laws, but what's going on like in your business. So like now I actually, I used to have a bad habit of like not talking to them until like the end of the year because usually they'd avoid me like the plague. But now it's just like, no, I'm gonna talk to you every month at least.
Well, I think that's probably our CPA's biggest problem is she's understaffed and has too many clients. I mean, she's constantly telling me she's, and again,
and it's
I feel like
harder
if we
without
were
the staff. It's harder without the staff because when I picked up the staff, that's what opened me up more to be like, what are you actually doing? What's going on in your business? Tell me about it. I'm excited. I'm an entrepreneur too.
right. And I would like to know what my credits are at the beginning of the year.
Yes.
Well, I think knowing your credits and knowing what your opportunities are, it makes you understand better what your salary needs to be for the year. In November or, no, October, Natalie, we'll do a class where we do some business planning like we did last year. And we don't talk about any of this on that business planning worksheet at all, right? We talk about how much do we need to survive? What are our bills? What are the taxes on those bills? What do we want to survive? What are the taxes on that? And then what does it cost us to run our business? And what are the taxes on that? So those are the 6 buckets that we talk about, but we don't ever look at strategies or things that we could be doing. If you hit this, then buy a house. If you hit this, then takes this, then think about this. And I think that should be part of our tax strategy. I think I'm going to interview a new company next month. I think when I interview the people who I have a feeling will end up hiring for our financial advisors, I think I'm going to see who they suggest. And then I want to interview a friend of mine's CPA firm.
Yeah, reflecting back on our planning last year, it was basically, this is how much money you're going to make from your 48 houses that you're going to sell. Just take 30% off the top, put that in a bucket to pay Uncle Sam later. and then now you got this much money to spend, and is that, you know, and that was it. That's the conversation. And it shouldn't be. It should be apply all of this to make that 30% much smaller. Wow.
Yes.
Okay, good. I'm glad. I feel like, are you guys glad that we picked this book? I know some of it's a little deep. And
Girl, yes. OMG, I love this book.
Oh, it's exciting.
It's very motivating to start doing the right things.
Yeah. Yeah. And it's like, it's your money. This is money that we're making today, that we're paying out today. And
well, and it's such a different perspective in the book. Like, you know, we grew up, or I grew up hearing, you know, the rich get richer, the rich screw the government, the rich do this, the rich do that. And it's actually quite the opposite. The rich are just the government's puppets.
Yeah, they're doing what they want and reaping the benefits.
And so I'm very thankful for that shift in perspective, because I think perspective a lot of times has a big impact on your success or failure rate. You know, growing up, I was always taught people with money are bad. Well, why would I want money? I don't want to be bad. And so for me, it's a great book, because it's one, it's changed my perspective, and two, it's opened my eyes to, you know, 15 pages of tax laws and 950,000 pages of tax breaks.
Exactly.
I mean, it's something. I mean, it's a way. Hey, give yourself a raise without doing anything else. I mean, because I don't know. I mean, unless you're already doing 100% of this, I don't think anybody can read this. That, oh wow, I can give myself a raise just by without changing anything that I do other than how I report.
Exactly.
A big raise too, like probably 20-30% raise.
Right. Like that's the tax rate.
That's the tax rate, let alone, I mean, with the depreciation and everything you're talking about. I mean, that's not even so much, you know, tax rate issues. I mean, that's just money that's just sitting there. Like, hey, take it.
Right. And actually, I'm not gonna lie, I understood amortization. I never really understood why it was said, because intangibles are really actually kind of hard. You have to do so much valuation around it. But I mean, if you think about it, like if you go and purchase a trademark, if you go and purchase a patent, like like Craig, you do all of this stuff, right? It's like I can go and put that on the balance sheet and then be like, you know what? That's an amortization.
Yeah, because
like,
you
yeah,
appreciate goodwill, right?
Right.
Yeah.
Like goodwill is an intangible asset that you
can. Yeah.
Right. Yeah. So it's like, you know, a lot of these services and, you know, like a lot of the legal work that just needs to get done. It's like so many people are like, oh man, you know, how can I get that for cheaper? I'm like, I don't know, that's a $20,000 thing that I can write off for the next 5 years. I might just pay it. You know, so and I feel like if we think that way, it's less of, you know, because I don't know, I feel like a lot of times it's like, yeah, I've got a team, but I'm not gonna pay them. Like, why? Why?
Well, we're so programmed with companies like H&R Block, like, oh, why would you do all of this? Go, you know, go hire us. It's only $25 or $100 or whatever their small minimal fees are. And it's like, with the right, even a W-2 employee could potentially be getting tax breaks if they would start the right kind of businesses. And to his point, it can be small. And I just think it's a lot of it is lack of education and lack of knowledge. You know, our school systems, they're set to breed factory workers. Well, right. I mean, that's they're set to breed employees, not entrepreneurs. And I think we do our kids such a disservice and not teaching them about this kind of stuff at a young age where it's actually sinking in. You know, you guys are talking about college courses and, oh yeah, I remember that. But think about if you'd have learned this starting in 6th grade.
Yep.
Right. And to add to that, I feel like you know, even with what's readily available, like we're being trained to be employees essentially. Even I feel like individuals that kind of go beyond that, it's just like, well, I'm gonna have some kind of entrepreneurial spirit. They're still on the same side of the quadrant. So it's like you really just gotta fully know, like you gotta have the team at least that knows it so that you can start making that transition to the other side. Even that doesn't get you away. The entrepreneurial spirit on its own doesn't get you away from it.
Nope, you gotta
It's
know
all
how to.
about leverage.
Mm-hmm.
Okay, well, so for next week, we're gonna wrap up part 1 by finishing chapters 11 through 14, and then we'll start part 2, which is on your
Sweet.
tax strategy for tax-free wealth. So very exciting.
Wait, 11 to 14.
Yes, sir.
Perfect. Peace. I'll see y'all next week. Same time, same place. Natalie, will you be in bed again next week?
I hope to be, yes.
I love work from home days.
Yes.
Oh my goodness, yes. I'm at home.
You guys like my boyfriend.
I don't work from home too often anymore, but I do enjoy it when I do, sitting on the couch.
Look, you guys are close enough from home to home. You guys are working from home.
Right. 3-minute car drive is not terrible. So
Awesome.
sweet. Well, I will see you guys next week. Good luck. Have a good week. Peace.
Thank you. Bye, guys.
See y'all.